Ladies and gentlemen, we have just got some new massive news about the US credit rating. Right now, the markets are deep in the red and are very volatile, and every single day the US government doesn't reach an agreement, the likelihood of default increases massively. We also got some more news on what the Federal Reserve plans to do with interest rates, and this will also have massive consequences for the US debt, for the US government, and for our economy and your job and our financial futures going forward. Because people, even if the US government does reach an agreement, it may already be too late. So everyone, we've got a lot of massive news to get in today, so let's not waste any time. Let's get straight into the news, the facts, and the data. Okay, first things first, before we get into the US credit rating potentially being downgraded, we need to look at what's happening in the markets right now. Because I don't know about you, but this week, there's been a lot of turbulence in the market. The market has traded down every single day, and the increases of a default is becoming more and more likely. So US stocks, bonds fall as debt impasses continue. So that's where I run. The Dow dropped around 250 points today. Everything was down. Gold, silver, bonds, cryptocurrency, Bitcoin's getting very close to that 25,000 level again. So the markets are actually getting uneasy that there may be a chance that the negotiations actually go past the X date. And this came after even bigger losses in the European markets, where many of those indices were down over 2%. And that's because UK inflation is still very, very high. So that may be a sign to say that inflation in the European zone and also in the US, Australia, etc. may stay elevated for much higher than they thought, and that means interest rates are going to have to keep going higher, and that means the likelihood of a US government default gets even higher. Listen to this. So yields on short-dated treasuries continue to push higher, with investors demanding a higher premium on US debt with the highest risk of default. So which debt is the highest risk of default? And again, I'm going to go into that credit rating in just a moment. Keep on listening. Treasury Secretary Janet Yellen said the US was likely to start missing debt payments as soon as June 1st. As such, the yield on securities maturing June 6th pushed above, look at this, 6.6% on Wednesday, while those maturing May 30th are yielding around 3%. So the investors now holding these bonds are facing big losses if they're forced to sell right now. And also what this is going to mean, we're going to see the yields on all other bonds, they're going to start increasing as well, like what we're seeing with the 10-year US Treasury yield. Now, you may be thinking, well, why does it matter bond yields are going up? Well, that means mortgage rates go up. That means credit card rates go up, car loans, everything. Portfolio managers said, I'm starting to get the feeling that Republicans don't believe in Yellen's X date and think they have the upper hand. The risk could mean there's no short-term solution, the S&P 500 breaking lower. Also, China's surprise index collapse should be bad for risk sentiment. Now, the risk for the US government default has hit 25%, according to JP Morgan. So the odds of US going past default date are about 25% and rising, JP Morgan says. They said, we think there's a very high likelihood Treasury would prioritize principal and interest payments. While doing so would avoid a technical default, there would be several adverse effects, including a likely downgrade of US credit rating. Well, people, we did just get that news. Look at this, everyone. US AAA credit rating may be cut by Fitch on debt limit impasse. This is absolutely massive, everyone. Fitch has a US credit rating on negative watch, and if the US government does get its credit rating downgraded, we're going to see interest rates on bonds spike, we're going to see interest rates on all loans spike, and we're going to see not a recession, but a depression. Fitch Ratings said it may downgrade US credit ratings to reflect the worsening political partisanship that's preventing a deal to solve the national debt crisis. And that's right, it's not a national debt ceiling crisis, it's a national debt crisis, everybody. And it is mathematically impossible for the US government to repay back its debt. And while we're never hearing anymore about should we pay down our debt, it's all about how much more can we increase it. Economists project a US default would trigger a recession with widespread job losses and a surge in borrowing costs. Still, it's not unusual for Congress to strike budget deals at last minute when the pressure becomes great enough to force negotiations to make painful choices. Now, I don't know about you, but if you lent money to someone and every single week before that money was due, they put on a big song and dance and tried to negotiate saying, no, you actually need to loan me more money, otherwise I can't pay you back the previous money I just borrowed, what would you do? Would you keep lending to this person? I don't think so. We believe risks have risen that the debt limit will not be raised or suspended before the X date, and consequently that the government could begin to miss payments on some of its obligations. And if you think this is impossible and it won't happen, it actually has happened before in 2011. In 2011, S&P Global Ratings drew fire for downgrading the US from AAA after similar brush with default. It has retained a stable outlook on the rating during the latest fracas, anticipating a deal will be struck. But you need to look at the bigger picture. Even if they do strike a deal now, interest costs are absolutely skyrocketing. This means the US government servicing costs are going to increase by the trillions, and there's going to be mass cuts to government spending. Now, economists are projecting if the US government does cut spending, this could slash economic growth by 0.5% and place us into an official recession. But also what many people aren't thinking about, what if the unthinkable happens? What if the Federal Reserve has to keep on lifting interest rates and the US government can't afford to repay its debt? Because look at this, the Federal Reserve minutes just came out and Fed officials lean towards pause in June, but they're not ready to stop. Now, the information we got from these minutes mean the Federal Reserve's pause in June doesn't mean they're going to stop lifting interest rates. They're saying there's most likely a 70% chance there's going to be another hike in July. Now, the Federal Reserve is very divided right now. It seems about half think they want to pause lifting interest rates and see what the economic data says, when the other half says, well, why should we do that? Core inflation is still 4.9%, 2.5 times our mandate. We need to keep hiking until the job's done. And I agree with the latter because the Federal Reserve made the same mistake in the 1970s. They spiked interest rates and then they saw inflation started to go down and they preemptively started cutting interest rates only for inflation to surge again. And that's exactly what will happen this time. If they start cutting interest rates late this year, like the markets are anticipating, we're going to see inflation surge again. And then like in the 1970s, they're going to have to lift interest rates even higher than before. They could go to 7 or 8%. And if they do, the US government isn't going to be able to afford to service its debt. We're going to see these debt ceiling talks start to happen every 6 months. Because the Federal Reserve said there is inflation risk. Several of his colleagues have pushed back, arguing interest rates need to keep heading higher amid a still strong job market and persistent price pressures. Policy hawks worry that inflation isn't falling fast enough and won't unless they stamp harder on the brakes. Almost all participants stated that with inflation still well above the committee's longer-term goal and labor market remaining tight, upside risk to inflation outlook remain a key factor shaping the policy outlook. So what this means, everyone, is the Federal Reserve is panicking right now. They've lifted interest rates to 5%. They thought they would never have to take interest rates this high. And I told you, I warned you for the past year that if they do go above 5%, that's when we're going to start to see things in the financial system break. We've seen 4 US banks collapse, and they know if they have to keep on lifting interest rates, we're going to see more bank failures, but an even bigger financial crisis. So everyone, I know you're thinking, well, okay, what does all this economic jargon mean for you in simple terms? What this means is, everyone, the markets aren't happy right now. They're very nervous. They're not sure what's going to happen with this US government negotiations with the debt. Even if they do strike a deal, there's not going to be money going out right, left, front, and center like 2021 and 2022. Companies' earnings are still going to come under pressure like we're seeing in the economy, and stock valuations need to come down to reality to reflect these earnings. We may get some surprise inflation data that forces the Federal Reserve to keep on lifting interest rates. The US government is getting very close to having its credit rating downgraded, and if that does, interest rates is going to skyrocket and we're going to see mass defaults. But everyone, what do you think about all of this? Let me know down below. Now again, if you want to check out my free newsletter, link in the description. Thanks for watching. I'll see you all in the next video.